Hi, everybody. Great to see you tonight. Thanks for coming, and I'm looking forward to chatting a little bit. My instructions are that I've been told that many of you have heard this before, heard the basic story of what Burford does before. And I'm also told that there's a fairly significant interest in having some Q&A. And so I'm not going to start at the very beginning and take you through the very basics of what we do, except in a couple of sentences. If you aren't familiar with the business, then you will find on our website a bunch of resources. You'll actually find some nifty sort of investor introduction videos that use some new technology to take you through what we do. You'll also find a newly updated, pretty comprehensive investor presentation that we just put up recently, along with all of course, of our earnings material and so on. So in the one paragraph version of what we do is that we're a specialty finance firm that is focused on the legal sector. We take the underlying value of claims, litigation, arbitration, any other kind of dispute. We treat those as financeable assets because they are, after all, an effort just to get money to go from one party to the other. And we construct financing packages around those financeable assets. We do this all over the world. We do it in scale. We do about $1 billion a year of new business that adds to a portfolio that is now $7 billion in size. We've generated consistent and fairly high returns over the 15 years that we've been doing this. And the cash flows that we generate all come out of dispute resolution processes, court judgments, arbitrations, and so on. And as a result, they're entirely uncorrelated. Those cash flows are entirely uncorrelated to either markets or economic conditions. This slide that's on the screen talks about the four things that make up our value proposition. To begin with, we've got a very large portfolio of existing investments. As I said, we've been doing this for 15 years. Litigation cases can take a long time, and so as a result, that portfolio includes a lot of stuff that we invested in over the years, and it is all on a conveyor belt that moves along to ultimately get to a resolution, either a trial court resolution, a win or a loss, or much more often, more than 70% of the time, a cash flow positive settlement. So there's real value in that portfolio, and cash continues to come out of it. We've already brought back more than $2 billion of cash from this business, and the portfolio is in a particularly active state at the moment because in addition to just the normal level of judicial activity, the courts, as you all know, like everything else in the world, were closed for a couple of years during COVID. And that created a judicial backlog. And so the courts are sort of actively working their way through that backlog right now. And that's translating for us into quite a high level of portfolio activity. So piece number one is just that big existing core portfolio that, if past practice is any indication, will throw off quite a lot of cash over the years to come. Piece number two is that we have an origination engine. We've shown that we can consistently, with 170 people or so around the world, we can generate a lot of new business every year to invest in so that we keep this machine running. Piece three is that we have the industry's largest asset management business in addition to the investing that we do on our public balance sheet. And so we take capital from institutional investors, those are endowments, pension funds, and the like. We have several $1 billion of assets under management, and we invest that capital alongside our balance sheet capital to generate returns for those investors and performance fees and sometimes management fees for us. That pool of investment management assets includes a significant deal with a large, well-known global sovereign wealth fund. And that provides us with hundreds of millions of dollars of effectively structural leverage to invest alongside our balance sheet capital. And fourth, some number of you will have heard about a significant case that we won last year. I was last here, I think, about a year ago. So you've seen a fairly significant progression in the share price since then. We won a $16 billion, that's billion with a B, judgment against Argentina issued by the federal court in New York. That judgment is in the process of both being on appeal, as these things always are, and also with enforcement activity starting. And Burford's share of that judgment once paid, is expected to be considerable. So that, in round numbers, is the Burford story. This is a little bit more granular, and this basically shows you the progression of the capital that we put to work. We start off on the left-hand side of this. We make commitments to people. In other words, we say to them, we'll finance your case for you, or we'll finance a large portfolio of cases for you. And by the way, we do this just on a commercial basis. This is not a consumer business at all. It would be very rare for us to do an investment deal that's less than $5 million. Our average size is about $30 million. So we're doing large dollar, complex, global corporate commercial litigation, not consumer litigation. So we make these commitments to finance cases. We put capital out the door as the cases proceed, or sometimes all up front if we're going to monetize a corporate position. And then we are effectively a buy and hold investor. There's not really a secondary market for litigation, as you can imagine. And so what we're fundamentally doing is waiting as that litigation judicial conveyor belt does its thing. And that moves at varying speeds depending on where you are, what judge you have, what court you're in. It may twist, it may turn, it may do unpredictable things, but ultimately it comes to an end. So unlike, for example, a private equity firm that needs a functioning market to be able to exit its investments, we don't need that. We get an automatic exit in every case that we do just by that conveyor belt coming to the end. And there are only three possible ways for a case to end. One is that you settle. You agree a resolution before you go to trial. That happens the most commonly, more than 70% of the time. And settlements are quite lovely because they are cash flow positive and they take all the litigation risk out of the equation. And as you can see there, we make a pretty nice return when cases settle. The alternative to settlement is that the parties don't reach a settlement and they go to trial. In that case, we're exposed to risk. We could lose the case, and we do lose sometimes, although we only lose 8% of the time, which is a pretty darn good rate, and that rate has been coming down over time as we invest more in data science and AI-style technology to do some of this alongside our human engineers of it. So we lose occasionally, but we win a lot more than we lose, and when we win, we make a lot of money. Because when you settle, you're fundamentally needing to take a discount, right? Nobody's going to settle a $100 million claim by paying you $100 million. They're going to pay you a fair bit less than that. But if you don't settle and go to trial and win, you might well get the whole $100 million. And so our returns are very high on cases that do represent a settlement. And this is a graphical view of this that shows the distribution. One of the nice things about this is that there's a lot of asymmetry, as you can see. When we lose, we're losing the capital that we invested. When we win, which is the red on the right, we can make multiples of that capital, and then the settlements are pretty much the stuff in the middle. So it's a nice, uncorrelated, asymmetrical business. This is a little bit of a complicated chart, but the fundamental message of this chart is to show you what is left in the portfolio. And what is particularly significant, and the black hashed bars here show you vintage year by vintage year what hasn't resolved yet. And the reason that this is significant is that our average duration of a case is about 2.5 or so years. And when you think about that, that's about right when you think about the justice system. If you start a lawsuit against somebody today, if you don't settle it, it's going to take you a few years to get to trial. If you do settle it, you'll probably do that faster. And so net, that works out to 2.5 or so years, and that's been pretty consistent for us over a long period of time. So what you're seeing here in the middle, in sort of the 2015 to 2019 zip code, is you're seeing cases that in a normal world, in a non-COVID world, probably would have resolved by now. And so they were delayed because of COVID, and now that's why I was talking earlier about a super normal level of activity. So it turns out that even though our cash flows are entirely uncorrelated to market and economic conditions, it turns out that they are entirely correlated to pandemics. And so we're making up for lost time there, and we're excited about what we're seeing in last year, this year, and the next while as courts continue to clear that backlog. This on the right shows you, again, just the sheer size and growth level of the portfolio, and the fact that it just elaborates a little bit on some of the points that we're making. I'd sort of stress the liquidity point here. We have, since Burford started life by listing here in London in 2009, but we added in 2020 a New York Stock Exchange listing, so we're dual listed in both markets. That's been a real win for us because it has also opened for us access to the US debt markets. And so we've been able to finance ourselves at very attractive rates. We have clearly the lowest cost of capital of any pure play litigation finance firm. And it also means that we have access to very substantial liquidity. We in fact added to liquidity earlier this year, and in the space of literally 4 hours, we were able to raise $275 million. This shows the kind of new business activity that we're seeing. This is inherently a volatile activity. This is not a consistent business where every quarter the same thing happens reliably quarter in, quarter out. And that's why it's also difficult to forecast the business, because we don't really control, first of all, we don't control at all when judges do their thing. We don't have very much control on when defendants decide to settle cases. And even on the new business side, we're pretty much in the hands of what is going on in the litigation market at any time. And so that leads to a fair bit of volatility on a period by period basis, so much so that even though we report on a quarterly basis, we don't really manage the business that way. We manage the business on a much longer trend line. But this, on the other hand, shows you on the top realizations. In other words, cases that have concluded and the amount of value by quarter that we're getting from that. But on the bottom, significantly, this is the cash, the actual dollars of cash that we're bringing back in. And as you can see, we've had very high levels of cash receipts over the last year, and that has continued through the current period. Again, we use some debt financing, but at a very moderate level. And we have an awful lot of liquidity in this business. So to sum up, and then I'll take your questions, we're pretty excited about where we sit today. We're by far the market leader in this space. This is a large market that is growing. There is, every year that goes by, there is more corporate interest in using third-party capital solutions instead of diverting operating capital from your own cash supply to do things that, frankly, investors don't really value. Leaving Burford aside for a moment, when all of you look at other operating businesses and consider investing in them, you're not giving that business any credit for doing a good job managing their litigation. You're interested in what that business is doing in its core activity, the thing that is going to make you money, the thing on which you're going to give it a market multiple. Even if it's doing a great job pursuing a few litigation claims, you're not going to give it a multiple on those claims. And so that creates this pretty strong positive incentive for those businesses to do something else, to not divert their precious operating capital into collateral activities that the market doesn't really value. And so to the extent that the business can use my capital instead of their own for those collateral activities, that's really a win. You could almost think of it as leasing for litigation, if you will. And so with that, I'd be delighted to take any questions or thoughts you have. Sir. Sure.
Please wait for Mark before you ask a question.
So is litigation gonna go up if we see an economic slowdown and we start to see more insolvencies, more administrations, and more debt defaulting? So in other words, are you negatively correlated with the economic activity?
I'll let you in on a little secret. Litigation always goes up. Every single year. The question is just what is causing the particular rise in litigation, and you identified some of them. Right now, for example, you're seeing a rise in insolvencies in a way that you didn't see, especially during the pandemic. We were putting so much stimulus into the market during the pandemic that you had a historically low level of complex bankruptcies. That now, with an increase in interest rates, has reversed itself, and so now you're seeing complex insolvencies come back to life, and as a result, that's an area that we certainly spend time on. But there are a bunch of factors that contribute to growth in litigation in addition to just the sheer growth in the economy. But that is a factor. Like, as the economy grows, there's basically a certain number of disputes almost per dollar of GDP, and so as GDP grows, whether it grows fast or slow, you're still adding more disputes into the system. But there are other dynamics in play as well. For example, right now there's a relatively robust level of competition and antitrust enforcement going on in both Europe and the United States. You've probably read about that. That tends to ebb and flow a little bit with the political persuasion of the parties in power. So the conventional wisdom would be there's a little bit more when Democrats have the White House, a little bit less when Republicans do. But all of those things are relatively minor variations in an overall mix where there's just massive amounts of litigation. Like, just to frame it up for you, there's well over 500,000 new pieces of civil litigation filed every year in the United States. So this is a very large activity. There was a question right here. Sir.
Yes, you mentioned that you have a lower cost of capital compared to your other competitors. I was wondering what other unique selling points you have compared to others like litigation capital and Manolete Partners.
So you're asking in particular about
yes, what are your
LCM and Manolete?
Yes, unique differentiators compared to.
So I'm not sure that I really want to talk a lot about individual firms, and both LCM and Manolete, although they're public and that's why you're aware of them, are awfully small compared to us. But I'd say in general terms, when you think about our competitive advantage and the moats that we enjoy, one of them is certainly scale. We are able to do every kind of litigation everywhere in the world that major corporations and large law firms seek capital. And that's a particularly big advantage for us because it means that the people that we have relationships with, the law firms, for example, like a Freshfields or a Clifford Chance or something, they can use us anywhere they need to, and we're available to them. Beyond that, though, in this world where data and technology are increasingly converging and important, we have a very significant advantage when it comes to data and technology. And the reason for that is because we've been doing this for a long time and we've been doing this in scale. And so what that means is we have a large proprietary data set, we believe by far the largest in the industry. And we're able to use the insights that we can glean from that data set, especially as we do more and more investment in data science, to be able to pull out insights from that. And the reason I'm emphasizing that is that when you think about litigation, what you read about, the stuff that is public, are the cases that go to trial and win or lose. So those are effectively the shoulder cases. But almost every litigation settlement is private and is confidential. And so it's very difficult to get that data, and we have a lot of it. And so we've been investing in data science since 2017. I have a team of people, physicists and people who have no legal background at all that sit alongside the investment team and work in parallel, and we use the insights of all of those people together to make good investment decisions. There's a
Question here, please. This
Sir.
gentleman first, yeah.
Thank you for the presentation. I'm sure you get sick of answering this, but can we have an update on the YPF?
So I'll give you an update only to the extent that I can. So this is the large case I was mentioning before about Argentina, and there are really two prongs of activity going on right now. First of all, as with any trial court decision, you have a right of one level of appeal. That's true here in England. You can go to the Court of Appeals, and it's true in the United States. You can go to the Second Circuit Court of Appeals. So the appeal is in process. Briefing, the exchange of paper filings will be done by the end of August. That means it's very likely that the appeal would be orally argued in the fall, in the autumn. And so then realistically, the court will go away and write a decision. It's sort of anybody's guess about how long that would take, but it's a reasonable assumption to think that would happen at some point during 2025. After that, there's no more right of appeal. There's only the potential for a discretionary appeal to the US Supreme Court. And just like the UK Supreme Court, that's very difficult to get to for an ordinary commercial case, even a large one. The Supreme Court tends to focus on constitutional questions, questions of sort of major national importance, and not so much private contractual disputes, even ones that come with chunky outcomes. So, it's never impossible, but that's a fairly unlikely statistical event that you would go one more level of appeal. So that's sort of prong one. Prong two is that Argentina was unsuccessful in getting the courts to stay the judgment. In other words, to not let it be enforceable while the appeal was pending. And so the judgment is enforceable, and that means that we have started a variety of enforcement proceedings. These are sort of bureaucratic at the beginning because you have to go through, in every country that you're trying to enforce in, you have to go through a process of a multi-month service and so on. So those are all underway, but nothing of great moment is happening in them at the moment. So that's where we sit today. Bruce.
Sorry, can I just pick up
Yep.
Just bring it up.
that my colleague just mentioned? On the 20th of April, the Buenos Aires Herald reported that you, Burford, had requested Judge Presca to grant them all of Argentina's shares in YPF, the government's 51% stake. Can you just talk about, insofar as you can, what was the logic behind you requesting that? I mean, I can think of one very good reason, but I'd be very interested to know what your views are.
Yeah, so the way that you go about enforcing a significant judgment, and this is true whether you're talking about this judgment against Argentina or really anything that you're talking about. Some of you will have seen us do a pretty public judgment enforcement a couple of years ago against a Russian oligarch. There was a $500 million English judgment, and it was titillating to the media because one of the assets in issue was the world's second largest super yacht. And what we're trying to do when we engage in this process, and we have a specialist business that just does this, is you're basically trying to use the various levers of the legal system in a way to apply some pressure to get to a dialogue, to get to ultimately a negotiation. It's not realistic in most cases for you literally to sort of walk around the countryside picking up an asset here and an asset there and trying to monetize them. That might work in smaller cases, but it doesn't work in really big cases. So what you're trying to do is create a climate where the judgment debtor is interested in getting to resolution. And you do that by pushing on, as I said, using a variety of levers, pushing on a variety of strategies sort of everywhere you can do. So what you're referring to in particular, there have been any number of things that have happened in trial court in New York since the judgment, ranging from us seeking various kinds of discovery from both Argentina and YPF and third parties. What you're specifically referring to is a motion for what's called a turnover order. And a turnover order is one of the tools in the court's toolkit to try to get judgments enforced. And it's what it sounds like. It's an order requiring a judgment debtor to turn over property to either the creditor, the people that we represent, or to the court for further proceedings. And so one of the assets that we identified and that we brought a turnover motion for was the government's interest in YPF. And the reason for that in particular, as outlined in the brief, is because those assets, we believe, satisfy a number of statutory conditions that are in a law in the US that governs this kind of stuff.
And just one further question. Do you, to what extent do you think the core business revenues, based on the charts you've got there, and in a note you put out in March last year, you did a business review of 2022, and you showed that the model of Burford only realised gains, which is future revenues, from the new commitments you made in 2020, that the gains from the 2020 ones would be 350 million, from the 2021, 750 million, and from the 2022, 900 million. Now, those are future revenues. And I just wonder whether that profile, I'm sure that profile won't materialise like that, but it does point to quite an upturn in the core business revenues over the next 3 to 4 years. Is that a picture that you would go along with?
Yeah, like without going into the numbers, since I don't have those particular things in front of me, what I think you're seeing is the combination of two factors, right? You're seeing, and I'll go back actually to the slide that I put up before. So you're seeing two things at the same time. You're seeing growth that yielded large recent vintages that should proceed through the court system at a normal pace. So the court system basically said, there was sort of two choices when they opened back up after COVID. It's like, we can treat everything in one long queue so that, we've got a couple of year backlog. So if you're filing a new case today, you're going to go to the back of the queue, and that means that every case is going to take a long time to get through the system. Or what many courts did is they didn't do that. They basically created a two-track process so that if you're filing a new case today, it's going to proceed more or less normally through the process, while we also on the side try to clear this COVID backlog. And so what that has the potential to yield is basically those more recent vintages continuing to progress in a normal way, while the delayed vintages because of COVID also proceeding through. And so, depending on the timing and the way the conveyor belt works, that has the potential to create supernormal levels of portfolio activity and therefore income.
Question at the back,
Chris,
please.
thank you for coming to see us again. I was here last year, and I can also say quite fairly thank you for all what's been achieved in the last 12 months. So it's therefore frustrating that the share price in the last 12 months hasn't really moved at all. And I was wondering, is that a London stock market issue? I mean, you seem to be doing all the shareholder engagements. The results all look pretty good, but it may seem unbelievable. I did actually just check on the London Stock Market Exchange chart, and unfortunately, it really hasn't budged for this particular 12 months.
Well, I suppose it depends on when you start the clock from.
Well, 12 months.
Right. So starting it from that may well be right. If you go back only a couple of months before that, the chart is up and to the right a fair bit. Like I think for calendar year 2023, the share price didn't quite double but came close. So as to sort of short-term fluctuations, I'm sort of in your hands. You're the people in the market, and I'm not. But I don't have any particular.
No, I mean, I guess obviously it's quite understandably it's sort of way off its long-term high, and it has picked up quite a bit for that. But will the New York listing, will that sort of help that? There's a lot of companies that are on the London Stock Exchange that are struggling big time, especially investment trusts and such. And I just wondered, is there any action you think you might be able to take to get a better rating?
Yeah, I think part of the rationale behind adding the New York listing was just that. It was to expose the shares to a larger pool of liquidity that historically has come with a somewhat higher rating, and also, frankly, with an investor base that is somewhat more familiar with litigation, because Americans, just at a consumer retail level, live litigation more than people in other markets. You drive down the highway and you see billboards advertising, call 1-800-SUE now. So that was certainly part of the hope, and I think it frankly has worked. We've seen a meaningful increase on the register of U.S. shareholders. That being said, look, I think the cold hard reality is that YPF, this Argentinian case, is at the same time, a very significant opportunity, but also a little bit of a market puzzle, because it's difficult to model Burford without modeling what you think is going to happen in the YPF case. And I don't know the answer to that as I stand here today. I couldn't tell you. I don't have a secret little piece of paper in my desk that has a pretty reliable prediction of date and amount to be paid. And so the fact that you find it difficult as somebody who's modeling the business to do that, I think just makes it a little bit harder for people. And I think that it would be a very nice outcome if we managed to finish YPF, get some cash in the door from that, and go back to talking principally about the core business.
Seeing as we're discussing suppressed valuations, any spare funds that you do have? I was at a meeting recently with another funder who hinted at some withdrawal from the sort of private funding side of things in the States. Are there any spare funds that might be available either to go and pick up some other funders, or are you seeing that you're able to recruit some of the key personnel from those firms into Burford anyway? And as a potential other use of funds, I know you've already got the buyback to make up for the deferred compensation. Mm-hmm. Could you do a buyback in excess of the demands of the compensation?
So on the other funder point, I guess that we don't see, generally speaking, an enormous amount of value in M&A transactions with people like that. We already have the funds platform. We already have the brand and market position. There's not somebody out there that you look at and say, oh, look, I really want to be in country X, and I don't have any footprint today in country X, but they dominate it. There's not really somebody like that. Fundamentally, you're talking about people who are in London, like us, people who are in New York, like us. So we haven't seen, really a lot of impetus to go and spend cash that we can invest at high returns to go and do, M&A transactions just to pick up another funder. We do hire from time to time when we have a gap, although we also do quite a lot of organic hiring and so that we train people into our culture instead of importing from what is often, frankly, a less successful culture. In terms of buybacks, the fact of the matter is we're growing the business a fair bit. We're using some amount of debt capital to do that, which by definition effectively means right now, if you did a larger share buyback, you'd effectively be doing a debt-financed one. We're not sure that that's a terrific idea. And on top of that, I think what the shares need is, especially for the US market, as much liquidity as you can give them. And so doing a big buyback where you sort of suck a bunch of liquidity out of the market strikes us as probably not today the right thing, but I never say never, and it's something the board looks at on a pretty regular basis.
Christopher, thank you very much indeed for joining us this evening. We're there out of time, so thank you. It's been terrific.